This video is part of a series that applies psychology to financial planning so we can all make wealthier decisions. As a multi-billion-dollar investment and planning firm, Mission Wealth is able to give you the collective wisdom of thousands of multimillionaires. I'm Joey, your host in this series. I'm a practicing wealth advisor and professor that studied behavioral finance with Cornell and Harvard. Starting off this year, we'll be publishing 1 to 3 psychological topics that are relevant to what's going on in the world around us. To kick off the new year, we are going to chat about holding cash, market timing to avoid in 2024, and whether or not international conflict should play a role into your investment decisions. So to start off on topic number 1, let's chat about cash and recency bias. In 2023, the asset class that had the most amount of inflows was cash, with a whopping $1.3 trillion of value moving to cash positions. While a 5+% interest rate on cash appealed to many investors last year, the expected interest rate cuts over the next 12 to 24 months will prove cash to be a short-lived opportunity. As interest rates drop, this will have to go somewhere. And so where will cash go? Investors trying to decide by timing short-term industry trends will likely be punished. See, our brains are wired to make decisions that are over-reliant on the most recent data and events, which, by the way, is a well-documented psychological error called recency bias. This gets us into a whole lot of trouble when we start making investment decisions because we often make long-term decisions based on short-term information. Take, for example, the large gains of growth stocks in 2023. The Vanguard Growth Fund, ticker VUG, posted positive 46% in 2023. Investors will likely compare this to the Vanguard Value Fund, ticker VTV, which only earned 9% last year. Investors that notice this difference may ask, why do I hold value stocks when growth is doing so well? But if we rewind to 2022, a negative year, growth was among the worst performers, negative 33%, and value was among the best, negative 2%, which led investors to ask the exact opposite question. Why do I hold growth stocks when value stocks are much less risky? The 2-year returns over both 2022 and 2023 were greater for value stocks than for growth, despite growth stocks posting positive 46% last year. The key point, building a consistent portfolio means less of your dollars have to work as hard to make up for prior losses. Simply put, the more you lose, the harder you have to work to break even. A 10% loss needs an 11% gain to break even. 20% loss needs a 25% gain to break even, 33% loss needs a 50% gain to break even, and a 50% loss needs a 100% gain to break even. And yes, while it can be uncomfortable to systematically sell while the price is high and buy while the price is low, a process called rebalancing, history shows that it can create a smoother ride and comparable cumulative returns to the market. Over several years, avoiding the big market busts can be more profitable and emotionally easier than chasing the big booms. Take this comparative sample portfolio with 60% in the stock market and 40% in the bond market versus the S&P 500 since the year 2000. In positive markets, investors feel bad about not earning as much as the S&P 500. And in negative markets, investors feel bad about losing any money at all, even if their diversified portfolio did not go as far down as the general market did. See, there will always be a reason to be unhappy with relative performance when times are both good and bad. The key takeaway is that when making investment decisions, it's best to take a longer than 1 year perspective. If you can keep a 3 to 5 year focus on investment decisions, you will be doing yourself a financial favor with less of an emotional ride along the way. Let's jump to topic number 2, gambler's fallacy and recency bias. So the S&P 500 grew by about 24% and ended on a very positive note in the last quarter. Concerns that 2024 will be a negative year to compensate have started to bubble up. And while nobody has a crystal ball to foresee the market performance on a short-term basis, some history on how markets have behaved can help guide how we think about this reversion risk. Simply put, the markets don't follow a calendar like we do. For my fellow nerds, the data simply does not indicate that mean reversion occurs on an alternating calendar year basis. So here are some key points from the history of positive and negative years in the S&P 500 dating all the way back to 1928. Markets were positive about 73% of the time and negative about 27% of the time. Playing the long game means staying the course when you're in the red 27% of the time, knowing that the larger number of good times outweigh the bad times. Markets are only back-to-back negative about 9% of the time. And lastly, when markets have a positive year, like they did last year, they have historically followed with another positive year 54% of the time, and only followed with a negative year about 19% of the time. With history as a guide, this can help you contextualize the urge to think that we are overdue simply because the prior year was positive. But still, there are headlines of crises all around the world, and surely these will contribute to negative markets, right? This brings us to our third and final topic this quarter, international conflict. So we're going to chat about what's called salience bias and how this relates. And Billy Joel probably said it best. We didn't start the fire. It was always burning since the world's been turning. See, wars, famine, natural disasters, political rebellion, and protests reach global attention, with technology allowing us to instantly communicate from any corner of the world. The issue is that we all face salience bias, which is our inclination to give too much importance to information that is emotionally impactful. While sympathizing with humanitarian crises around the globe, many investors also grow concerned with how international conflict may affect their life savings. Russia and Ukraine, Israel and Palestine, protests in Iran, natural disasters in Japan, rebellions in the Democratic Republic of Congo, and so many more headlines that will make you want to bury your head in the sand. Ultimately, you may wonder, how much does international conflict affect the US stock market? And to answer this, we tracked how much revenue each country contributed to the revenue of the S&P 500. More than half the revenue from US large companies was generated within the United States. In total, there are only 9 countries that exceeded a 1% contribution to the S&P 500's revenue. These are China at 8%, Japan at 2.9%, the UK at 2.4%, Germany at 2.3%, Canada at 1.8%, Taiwan at 1.7%, India at 1.5%, France at 1.4%, South Korea at 1.1%. Outside of the top 9 countries, the other 185 countries contributed a total of 20% to the revenue. That's an average of 0.11% per country listed in the other category of the pie chart you're viewing. So what does this mean? Take the conflict in Russia and Ukraine, or Israel and Palestine. These countries fit into the other category with an average S&P 500 revenue contribution of 0.11% per country. The market revenue is not impacted by these countries because the companies with the market do not source much of their revenue from these countries. This does not mean we can't care from a humanitarian perspective, but it does mean that the US marketplace is mostly independent and that the international revenue produced from US companies is well diversified across the globe. In times of turmoil, the US markets have historically shrugged off international conflict. In fact, dating back to 1939, data analyzing what happens to the S&P 500 around dozens of geopolitical events indicate that the average US market tends to take just 3 weeks to reach a bottom and just another 3 weeks to recover to prior levels. To name a few examples, it took the S&P 500 9 days to recover from 2016's Brexit, 16 days to recover from the 2003 war in Iraq, 9 days to recover from the 1962 Cuban Missile Crisis, 1 day to recover from JFK's assassination in 1963, 14 days to recover from the 2014 Ukraine conflict, and 15 days to recover from the 9/11 attacks in 2001. In the year following geopolitical events, the market earned on average 13%. Even with this crystal clear data, some investors may still be concerned about US government spending on international conflict. Here's how material our foreign aid is relative to our federal budget and GDP. In 2023, the federal government budget for international aid was about $60 billion, which was about 1% of the $6.1 trillion total federal budget. Of all government spending, accounts for about 25% of the US GDP. And since foreign aid is only about 1% of government spending, and total government spending makes up less than 25% of our GDP, the total impact of foreign aid spending on our GDP is less than 0.25%. There remains 99.75% of our GDP unaffected by foreign aid, yet there are no articles online that will contextualize it like this. We can get caught up in the crosshairs of the attention-seeking media headlines when most countries represent less than 1% of our market's revenue, foreign aid represents less than 1% of the federal budget, and international spending on aid represents less than 0.25% of our GDP. We found these topics helpful as we enter the new year. For more detailed market commentary, I warmly welcome you to read or watch our Chief Investment Officer's market updates from our Insights blog. And to submit any requests for future topics, please don't hesitate to contact me directly at jkhoury@missionwealth.com. Wishing you a wonderful start to the new year. Thanks so much for tuning in.